Welcome to Talk Tickers. We're the place that cuts through the noise of earnings calls to give experienced investors like you the insights that, well, really matter. Today, we are diving deep into Nayax's second quarter 2025 earnings call.
Yeah, it was quite an interesting quarter. Some really strong operational results, some big strategic moves happening. Even though the market maybe took a moment to digest the numbers, we should definitely unpack the highlights and what they're signaling.
Okay, let's kick things off then. What were the headline numbers for Q2? How did they actually perform financially?
All right, so non-GAAP EPS came in at 16 cents. That was a significant beat, actually, way above the $0.10, so much more profitable than expected.
Okay, strong bottom line then. What about revenue?
Revenue was $95.6 million. Now, that's solid growth, 22% year over year, but it did come in just a touch below the consensus estimate, which was around $99.2 million.
Okay, so a slight miss there.
Slight miss there, yeah. But profitability looked good. Gross margin improved quite nicely, up to 48.3%. Adjusted EBITDA was nearly $13 million, which is about a 13% margin. And they also generated positive free cash flow, about $5.6 million for the quarter. So, yeah, maybe a slightly mixed revenue picture, but definitely strength underneath.
Right. And beyond just the financials, the operational metrics, they often tell a deeper story, don't they? What stood out there?
Oh, absolutely. Operationally, things looked very healthy. Total transaction value, TTV, surged 34% year over year. That's almost $1.6 billion passing through their systems.
Wow, 34%.
Yeah. And the customer base grew 24%. They're now at about 105,000 customers. Their installed base of devices also grew 16% to nearly 1.38 million.
Those are solid growth numbers across the board.
They really are. But the metric that for me really jumps out is the net retention rate, NRR. It's holding at a very, very high 123%.
123% NRR. That's top tier.
It absolutely is. And you combine that with a really low churn rate, under 3% annually. It just tells you customers aren't just staying, they're spending significantly more over time. They're clearly finding value.
Okay, that 123% NRR and the low churn, those are definitely standout figures. But how are they achieving that? I mean, payments can seem like a tough space. What's their moat here?
That is the crucial question, isn't it? And a big part of the answer, I think, lies in this shift towards recurring revenue. That was a major theme. Recurring revenue now makes up 74% of their total revenue. Just compare that to 68% in Q2 last year. That's a really significant jump.
74%. So they're deliberately moving away from just selling hardware.
Exactly. For investors, this pivot is huge. It fundamentally changes how you might value the company. They're becoming much more like a SaaS platform business, which, typically gets higher multiples. It means more predictable revenue, a clearer path to high margin growth. It attracts a different kind of investor.
And that ties into the gross margin improvement too.
Spot on. The gross margin hitting 48.3% was driven by improvements in both recurring and hardware margins. Recurring margin went up to 52.8%. That's partly due to better processing margins from new banking partners and, importantly, their smart routing capabilities.
Okay, smart routing. Can you break that down a bit? What does that actually let them do?
Sure. Think of it like Waze for payments. For every transaction, their system automatically figures out the cheapest way to process it in real time. It finds the most cost-efficient path through the payment networks. And that difference, even if it's tiny per transaction, adds up across billions in TTV, boosting their margin.
Interesting. So it's an ongoing efficiency gain.
Precisely. And even hardware margin improved up to 35.4% from about 28.7% last year. They put that down mostly to supply chain improvements, better sourcing.
Got it. They also made some strategic moves this quarter, acquisitions and partnerships. Which ones should we focus on?
Yeah, definitely some important ones. How do these fit the bigger picture right? Well, first, they bought the remaining 51% of Nayax Capital. So that's now fully theirs, consolidated under a new division they're calling embedded banking. That deal also brought a one-time gain to operating profit, about $5.6 million.
Embedded banking. So that's more than just processing payments.
That's more. This is key to their embedded finance push. Think about issuing cards, offering bank accounts, maybe even small loans directly through the NYAX platform. Imagine, say, a vending operator managing their business banking or offering customer loyalty cards all via NYAX. It makes NYAX indispensable, way stickier, and opens up totally new revenue streams.
That sounds like a much deeper integration, a commerce stack almost.
Exactly. They also closed the acquisition of Pay in the Benelux region, which strengthens their foothold in Europe and gets them into some new verticals there.
Okay, but the meme that really seems like a potential game changer is this expansion into EV charging. That feels different.
Oh, it absolutely is. This could be huge for them. They announced a strategic partnership with Autel Energy.
Autel, they're one of the really big global players in EV charging equipment, right?
One of the biggest. And Autel plans to buy 100,000 of Nayax's Unomini readers to embed directly into their AC chargers by the end of 2026.
100,000 units. That's what percentage of their current base?
It's about 7% of their entire current installed base just from this one deal. It essentially makes NYAX the payment standard inside those chargers.
And embedding it at the factory level must create some serious stickiness.
Enormous stickiness. Think about UL certification. It's a complex safety and performance standard. Once Autel gets its charger certified with the NYAX reader inside, switching payment providers later would mean going through that whole costly, time-consuming recertification process. It basically locks NYAX in.
Makes sense. Lowers NYAX's customer acquisition costs too, presumably.
Drastically. They acquire customers in bulk at the OEM level. They also partnered with Linkwell in the US.
Ah, Linkwell. That helps with the Buy America aspect for U.S. infrastructure funding.
Precisely. It gives them an edge in the North American market where there's a lot of government money flowing into EV infrastructure, often with domestic sourcing requirements. So it's a smart dual approach.
So EV is clearly a major focus. Are there other emerging areas they highlighted? Seems like they're looking beyond just vending machines now.
Definitely. Management specifically called out smart coolers and family entertainment centers as strong growth areas.
Smart coolers, like intelligent vending.
Kind of, yeah. Turning them into data-driven retail points with inventory tracking, analytics, the works, and family entertainment centers, arcades, ticketing, everything going cashless and connected. It shows the platform's flexibility. They also dropped a hint about, quote, big news and a big jump into retail within the next 6 months.
Into retail, like traditional retail, that could be massive.
It could be. It signals they're definitely moving beyond traditional vending, where maybe the cash-to-cashless upgrade cycle is slowing down a bit. They're targeting these higher ticket verticals. EV charging transactions average around $7 compared to maybe $1.60 or $1.80 for vending. That feeds directly into that high NRR.
Right, higher value per customer. What about that rental model for the hardware itself? How's that playing out?
They're really pushing that aggressively. It's another way to boost recurring revenue and make it easier for customers to get started. It worked really well for them in Brazil after the VM Technology acquisition. They apparently doubled devices there using rentals.
And now they're expanding it.
Yeah, they just launched it aggressively in Australia and have plans for other regions soon. It turns a one-time hardware sale into an ongoing subscription payment, which smooths out revenue and improves margins over time. It's smart.
Okay, so lots of strategic initiatives, strong operational metrics. What does this mean for their guidance? What are they telling investors to expect?
They actually reaffirmed their full year 2025 guidance. So revenue between $410 and $425 million. That's about 35% growth at constant currency with at least 25% organic.
Still strong growth expected then.
Yes. And adjusted EBITDA between $65 and $70 million with good free cash flow conversion, at least 50%. They expect the second half of 2025 to be stronger. It's partly due to shipping more of the new products like the Unomini for those EV deals and also larger enterprise deals that just take longer to close.
And longer term. Any updates on their big picture targets?
They've reiterated those ambitious 2028 targets, so roughly 35% annual revenue growth, aiming for a 50% gross margin and a 30% adjusted EBITDA margin. Plus, they flagged maybe one or two more acquisitions still to come this fiscal year, so clearly confident in executing the strategy.
Interesting. Now, the market reaction, you said it took a moment to digest. It wasn't an immediate surge.
No, it was a bit choppy initially. There was a small pre-market pop after the results came out, but then it sort of faded during the trading day after the call. Dipped slightly, but then it recovered the next day. It really felt like investors were weighing that strong EPS beat and margin story against the slight revenue miss. Classic Wall Street, right?
Yeah, trying to balance the signals.
But management's tone on the call was very bullish, very confident. They kept emphasizing the improving execution and this strategic shift to recurring revenue as the key long-term value driver. They think a re-rating is coming.
It really does seem like this embedded payment strategy, especially getting inside the hardware with OEMs like Autel, is central to their competitive edge. Are there risks there, maybe over-reliance on a few big partners?
It's a fair point to consider. Relying more on fewer larger OEM deals like Autel does shift the dynamic compared to acquiring thousands of small operators. But the benefit is scale and that incredible stickiness we talked about. Getting embedded with UL certification makes it extremely difficult and costly for that OEM to switch later.
Right, the switching costs become prohibitive.
Exactly. It's not just selling a payment terminal anymore. They're embedding their platform deep into the product lifecycle. That's a powerful position to be in.
And that high NRR and low churn we discussed earlier, how does that evolve as they move into these higher value areas like EV charging or potentially retail?
Well, the 123% NRR and sub 3% churn are already phenomenal. As they push into verticals with higher average transaction values like EV or parking, it naturally drives that NRR even higher because existing customers are generating more revenue per device. Plus, the move into embedded banking with Nayax Capital, that allows them to capture even more value from each customer, offering cards, accounts that become a much more integrated financial partner, not just a payment processor.
Taking a bigger slice of the customer's wallet, essentially?
Precisely. Moving towards that full commerce and financial stack for unattended businesses. That's the goal.
All right, let's shift gears slightly. For our listeners, the committee room has cooked up a couple of trade ideas. And remember, this is absolutely not financial advice, just some food for thought.
Okay, idea number 1. Consider a pair trade. Long NYAX, NYAX, in short, a basket of traditional point of sale, or POS, hardware providers.
Okay, interesting. What's the logic there?
Well, NYAX embedded strategy, getting the Unomini inside things like EV chargers at the factory, it completely sidesteps the old model of just selling a separate POS terminal. They're embedding a platform, locking in recurring revenue from day one. As unattended, IoT commerce grows, those old-school hardware boxes look increasingly, well, obsolete.
So NYAX is disrupting the hardware sale itself.
Exactly. They're building stickiness at the manufacturing level, owning the payment piece for whole product lines. That one-time hardware sale gets replaced by a long-term annuity. It's a bet that payments will keep getting more integrated, more modular, leaving traditional POS hardware behind.
Makes sense. And for those feeling a bit more adventurous...
Idea number 2. Long NYAX, NYX, and short a basket of publicly traded laundromat or car wash chains.
Okay, shorting the businesses NYAX serves. Explain that one.
Right, so NYAX results show they're enabling huge efficiency gains for these kinds of unattended businesses. Higher transaction value, better retention, the NRR, the low churn. Laundromats, car washes, they're fragmented, often cash heavy, and prime candidates for NYAX's full hardware and software solution. They're going digital fast, thanks to providers like NYAX.
So long the enablers, short the operators.
Kind of. You're betting on NYAX as the infrastructure provider capturing value from this digital shift. The short leg is a hedge. Maybe those operators face margin pressure eventually as digital payments become table stakes, more competitive. Or it's just a way to capture the value transfer as NYAX's tech makes these businesses more efficient, perhaps more than the market prices into the operators themselves.
Got it. Capturing the value shift. Interesting angles. Okay, so to wrap things up on NYAX's Q2, it really looks like a story of a successful pivot towards more profitable recurring growth.
Yeah, driven by that expanding recurring revenue base and these smart entries into high growth areas like EV charging, maybe retail soon.
And consolidating Nayax Capital, the acquisitions, they seem to be strengthening their position, especially in that embedded finance space.
Definitely. And while revenue was a slight miss, the strong EPS, the better margins, and sticking to the full year guidance, it all points to management confidence for a strong second half.
Yeah.
The story seems to be accelerating.
Absolutely. So as always, please remember this discussion was purely for informational purposes. It is not financial advice. Always consult with a qualified financial professional before making any investment decisions. Thanks for tuning in to Talk Tickers. Don't forget to subscribe for more deep dives. And maybe think about this. What's the next big overlooked physical space you see that's just ripe for this kind of digital disruption?